Welcome to the Business SOS podcast. This is Rich Sierra, President of the Florida Small Business Legal Center. This is episode 136 of the Business SOS podcast. Thank you for listening, supporting me for the last 1.5 years now. So very excited as we continue doing our podcast, and I'm very excited to be able to reach a milestone of episode 200 in the near future, and I'm sure I'll have a big celebration for that. That's a very big accomplishment. As you know, from the last week, I started talking about partnerships, disputes, and what happens when there's a deadlock in partnerships. And we talked about that last week. So this week, I want to talk about, what to do or what to consider if you're looking to buy a business. I'm getting more and more calls now for people that are interested in buying a business or selling a business, or perhaps one partner selling his interest to somebody else, and so a new partner comes in. So this is going to be a two-part series. So we're going to do the first half in this episode, and the second half will be in the episode next week. Simply, it's a lot of material to cover, so I'm going to break it up in two parts. So you are interested in buying a business, and I do quite a bit of litigation that involves with that, of buy-sell agreements that go wrong, go bad, and I want to talk about how to avoid that and some of the reasons that happens. But if you're interested in buying a business, it usually happens you come into some cash, or you have a 401k, and this is very common that I see people that are looking to retire. They retire early. Maybe they work for the school board or a business that had a pension, and they are with retirement age. Sometimes they retire very young, and they say, you know what, we want to start a business and to run it for the next 10 years, something like to that effect. They go online to look at business brokers' websites, or Biz by Sell, I believe it's a website that has businesses for sale, and the process begins. In many cases, some of the people looking to buy a business haven't owned a business before. They have management experience from their previous jobs. They have some professional experiences, but running a business is very different than working for someone. You take all the risk. You make all the decisions. And whatever mistakes are made fall upon you. There's no fallback here. You are the one that will live with the rewards, live with the consequences of decisions that you make. So it's a very different type of dynamic when you own your business versus you work for someone else. And some people try to make that parallel, that I worked for a company for 20 years. I was successful at this company. I was in management, so therefore I can run a business. It's a different skill set, and you'll find out why. So one of the things that I recommend, if you're looking to buy a business, you definitely want to have an attorney help you with this. And I'll tell you why. Many of the litigation that I get involved with involves people that buy businesses, but they choose not to get professional advice. And that is significant, whether they don't get CPA advice, they don't get an attorney to help them navigate the process. They decide to do this on their own. That they decide to, work with the business broker. The business broker gave them all the contracts, and they say, no worry, we get all the paperwork done for you. They put significant amount of money into a deposit. They don't conduct proper due diligence. They buy the business, then they find out that the information that they thought about this business, or the perception they had about how successful the business was going to be, is different from the reality once they step in. And that's when they call me. And I ask the question, did you have an attorney at the time? And this answer is no. I'm not judging anyone, but I'm just sharing this with you, just simply to share with you that there's some mistakes that can be avoided by having proper legal advice, especially something as important as buying a business. So we backtrack a second and tell you what the process is, kind of in a nutshell, what the process of buying a business is. You first start with the interest, of course, that you're interested in this type of business. It could be like a distribution business, logistics, could be a restaurant, could be anything. Okay. It usually involves some merchandise or involves a service business. So contact the business broker uh, or the owner, and then they said, okay, this is the price. They provide maybe a one sheet, very basic financials about maybe the sales of the business, the how long the business has been in existence, number of employees, kind of basic information about the business, but they don't give you a lot of information for you to properly evaluate that business. And they tell you the asking price. Um, Usually, the asking price is not going to be the price you're going to pay for that business. You're probably going to have some discounts. You're going to negotiate, but it's usually not the same. Uh, so, say you're interested in that business, the next thing you get is an uh, non-disclosure agreement (NDA). So that way, any information is shared with you, you agree not to disclose it to the public and only utilize it for that purpose. Uh, if you feel that the information that you receive is okay, you want to pursue it further, then you get something called a letter of intent or LOI. And the LOI usually is not binding to the extent that in order for you to close in that business, you need to have either an asset purchase agreement or a stock purchase agreement or a membership purchase agreement. We'll talk about those three in a few minutes. So the letter of intent, I like LOIs. It's my preference. I don't like going straight to a purchase agreement because the LOI gives you kind of the basic foundation, the basic key points that have been agreed upon, subject to some contingencies. Okay, so the letter of intent simply said, okay, you know what? Uh, I am the prospective buyer of the business. I'd like to, offer you, for say $300,000. Say it's a laundromat, for example, uh, with say $50,000 down, $10,000 at the LOI stage, with 45 days to do some due diligence. Uh, and within the 45 days, I can cancel if I don't like what I see for any reason, and then I get my money back. It's kind of a basic, structure of to begin the process of evaluating that business. And during the time period that you're doing the evaluation, the seller agrees not to offer that to anybody else, not to make any uh, offer the business to anybody else, and allow you to conduct the due diligence. So, say the seller agrees to those points. Again, it's very basic. It's simply a way to show interest, but also you want to take a step further and see if this is going to work. So the LOI is signed, then that's when the hard work begins. That's the due diligence process. And many people kind of gloss over that or do not pay enough attention to due diligence. And this is where things go bad in the future. Uh, and I've heard, ask the question why you didn't want to get an accountant involved, CPA to help you with the financials, or get an attorney involved to help you. The answer is, we wanted to save some money. That is fine. That's your preference. You want to do that. However, the due diligence, an attorney helping you with due diligence or CPA help you with some of the financial due diligence is invaluable. It'll certainly help you in whatever money you spent on the due diligence. Okay, if you decide not to go further with it, those few $100s you spend, maybe a few $1,000s you spent, and evaluating the business could save you hundreds of thousands of dollars later in the future and a great deal of heartaches and headaches along the way. If you find out that, hey, this business did not pass my due diligence, that was money well spent. And that's the process of due diligence, to find out whether or not this business really fits your needs and will help you achieve your goals. Otherwise, why even bother? So I can not emphasize enough the importance of due diligence and not to skip steps in the rush of buying a business. This applies to franchises too. Sometimes people go to franchise expos, which are great, and they're interested in a franchise. And maybe they say, well, we know a franchisee that is interested in selling the franchise. Okay. There's a lot more structure with a franchise. When you're buying an existing franchise, you have to do a due diligence as well because they have employees just as well. They have revenues, they have royalties to pay. So it's a little bit more structure, but you have to do the same due diligence as well. So, what is involved in due diligence? Um, there are a lot of things, and that's a whole podcast in itself. But I will go over some of the items that I believe are important in a due diligence process. And this is not an extensive list. In fact, when I represent buyers for um, to are interested in buying a business, uh, I prepare the letter of intent, and you know, provide a term similar to what I just got with you just a few minutes ago. But I provide the seller with a 4 or 5 page due diligence list, a checklist to provide me every document that I ask for. And some of them I'll mention here now. And if it's not applicable, I write there, just write not applicable and to sign it. And it is important for them to sign that because later on, 6 or 8 months down the line, I get a call from my client, the buyer say, hey, you know what? Something is off here that I got a letter from the IRS that the business, owes payroll taxes, for example. So I go back to that checklist and find out, whether or not they provided the payroll taxes and whether or not they disclosed any issues. And if I see not applicable or do not have them, then we have an issue of misrepresentation. So that's why it's important to, go through that checklist and make sure that they verify they provided everything to you and they disclose everything that is material to you, for you to know as the seller, uh, as the buyer, sorry, that that is material to that business. So obviously, oops, there's a microphone fell here. I'll hold it for a second. The so obviously, what goes without saying, financial statements, profit and loss statements, you know, but I would ask basically is for the accountant version of QuickBooks. So that way you can run those reports independently with your accountant. You obviously cannot make changes to whatever information is there, but you can actually get those. Your accountant will know what reports to pull. It is easily to pull out. So I would ask for the accountant version of the of QuickBooks. They have it. Um, I would also ask for at least 3 years of tax returns, and that's very important to have. 1120 most likely is a subchapter S, with all the schedules. With all the schedules, and of course, you already have signed an NDA, so that information you cannot share with anyone as the buyer outside of your accountant or your attorney to review that business. Um, I would certainly ask for lease agreements unless the seller owns the building or it's a home-based business, which most of them are not. If it's depending on the type of transaction you have, uh, there will be a lease involved, a commercial lease involved, and that's a very important document to have. So I would ask for a copy of the lease agreement and any addendums or extensions, amendments or extensions they might have had with the lease. With tax returns, I would ask also for the in Florida, some of them have to pay sales taxes. So I would ask for the sales tax returns to the state. And that's very important because you want to make sure that if it's a business that collects sales taxes, uh, that those sales taxes are being paid to the state. But it's also number one. Number two, it also gives you a better idea of the sales that are coming from the business because those sales taxes the returns have to be made quarterly. the taxes have to be paid monthly. So I would ask for those returns as well. Payroll taxes as well, very important. The R6 reports that go to the state, and also the 941 returns, the payroll returns that go to the IRS. I would ask for that. I would also find out if they're running payroll through a payroll company or they're doing it themselves. And that's very important. Why? If they have a payroll company, like Gusto, Paychecks, or ADP, for example, usually these companies prepare the tax returns, they send them out, they have those reports available on their platform, and all you got to do, what all the seller has to do, is go to their platform and download them, and they're available, and they keep it in a schedule. Also, and it's very more likely than not that the payroll taxes are being paid correctly to the state and also to the federal government if it's done to a payroll company. So it's a less likelihood of mistakes when it's done to a payroll company that is done by the individual owner. So in the case that the seller is running his own payroll, then in my opinion, you got to have a higher level of scrutiny. Because the business owner has a lot in their plate. And you got to find out, how many employees they have. If it's something him and his wife are in the payroll, that's one thing. But do you have a number of employees? Say you have 10 employees and they're running their own payroll and it's not through an accounting firm, then you got to double check that to make sure it's been done correctly. So I will check on that as well. In terms of employees, you want to find out, are they W-2 employees or are they paying anyone as a 1099 independent contractor? Usually referred to sometimes employees as 1099 employees. That's a misnomer. That does not exist. They're either independent contractors or they're W-2 employees. There's nothing in between. Why do I mention this? Sometimes in the small businesses, I've seen that a business owner wants to save expenses, quote unquote, by paying an employee as an independent contractor. In that way, that employee avoids paying the payroll taxes. That could be an issue. So you want to find that out. Okay? You want to get that information in. And again, this is proper due diligence. I would ask for any loans that they might have. You can find that to the Florida UCC if they have any. If any lending company places a lien on the business, it's very common. If there's a lien on the business for a loan that the owner took, that's nothing negative per se. That's something standard practice that banks do to protect their interest. That is okay. What is important here is that if there's a lien on the business, if that business is going to be purchased, for example, by you, or the assets of the business will be bought by you, those loans have to be paid at closing. All those liens have to be satisfied through a UCC 3. So if they have loans, they have to disclose them. Okay, and you gotta want to get their copies of their statements, get payoff for those loans directly from the lending institutions, and then at closing, whoever is doing the closing agent has the responsibility to set those funds aside, and at closing, pay those loans. You do not want to buy the business with those liens there. They can pursue you as the new owner. So those things have to be satisfied, has to be paid off. And they have to disclose that at least in Florida, the UCC, Florida UCC, you can find out any liens paid, but they have to disclose them anyway. But as part of due diligence, we double check just in case. And in terms of lease agreements, you want to find out, okay, how many more years are left in this lease? Is it assignable? Uh, and at what point do you contact the seller contacts the landlord to begin the process of assigning that lease to you? Okay, so you want to find that out, and that gives you a better idea of the business going. Any outstanding liabilities the business might have outside of loans, or vendors, you want to see that as current. Uh, any litigation history. They have had losses in the past. An attorney can help you find that information. Did they settle a lawsuit recently? Have they gone to arbitration? Arbitration usually it's not in the public records. So they have to disclose that to you. Have they gotten any type of threat of litigation, a demand letter? You want to find that out. Again, that's part of the due diligence process. As you see, we're already 20 minutes into the podcast, and I'm just going over the surface of due diligence. So that in itself can be another podcast, but I wanted to give you an idea of how important it is. The business licenses that they have. They have the county license, city license. Well, the business tax receipt. They pay that on time. And it's current. Any trademark they have a logo. It's going to be assigned to you. Any physical assets, any type of equipment that you will be acquiring with this business, and the condition of that equipment. If it's a restaurant, for example, I usually recommend is to bring somebody that repairs or maintains that equipment to go in and do an inspection to see the quality of the quality of that equipment, how well it's run, and how well it's maintained. The same thing with the inventory. If there's inventory that you're going to transfer, it's usually at the end of the closing. There's an inventory that is made, and that's transferred to you. You buy it separately. So those adjustments can be made. So that kind of gives you an idea of how important the due diligence is, and why it's usually better to have a professional help you with this as opposed to doing it on your own. Why business sales go wrong? I want to talk about that before I go into the next segment. Okay. I've seen situations that buyers rely heavily on the seller's representations without verifying information. You have to verify. Okay, there's people are friendly, people are professional, or they rely on the business broker's representation. Again, the business broker is doing his job. I'm not uh, saying anything negative about business brokers. Their job is to put a deal together, and they will provide information to you. But please understand that they get a commission from the seller if you buy that business. They're going to provide information as they have it. But business brokers also have a statement. They'll provide a document to you saying, we're not responsible for anything that happens between you and the seller. It's your responsibility. Provide information to you as is, provide it to us, but you cannot rely upon any information we provide to you. That's the seller's responsibility, and it's your responsibility to do your proper due diligence. The broker will not get involved in any type of verifying information that you request from the seller. So keep that in mind. And it's not a good idea to choose not to verify the information. I've seen that before. They don't want to offend. They don't want to, somehow feel that they're asking for too much. Yes, you should ask for too much, and it's your right. If you're going to buy a business, spend a few $100,000 buying a business, it is your right to ask for that information, and it should be provided to you. And I've seen situations in which the buyer asks for the information as we're getting close to closing, because sometimes get extended, and you want to ask for the last 3 months of what has happened before the closing, and the seller refuses to provide that information because they don't want to. And the buyer chooses to close anyway. as opposed to walking away from the deal. And that's a fatal mistake, because you want to buy the business in the same condition as close as possible where it was when you first expressed interest. And sometimes closings get delayed for whatever reason. Looking for a contingency for financing, maybe some information took a little longer to get. There are a number of reasons why a transaction can get delayed. But there's absolutely no excuse for a buyer to agree not to receive material information about the business and choosing to close anyway. That's on the buyer to do that. So I can only emphasize, they don't want to give information is for a reason. And you should be prepared as the buyer to walk away from a deal if it's not good for you. That's why the period of the due diligence period is very important in asking for that question and insisting, yes, I want this information. If I don't get it, we're done. I'm walking away from this. So don't get emotionally attached to the idea of buying a business if they're not willing to give you due diligence. Walk away from it. If that's a red flag. We'll come back later to haunt you if you don't follow through. Another area that I see happening is that has happened before: sellers failing to disclose material issues that later become dispute. That, in essence, will not be your fault. If you conducted the due diligence uh, as you required, you asked for the questions, you asked for to provide information, but the seller knows something about the business that is material that can affect the business and did not disclose it to you, uh, and then you later find out, that's a problem. That's an issue, potential lawsuit later on for misrepresentation, fraud, and inducement, or at the very least, negligent misrepresentation. Okay, and I'll give you kind of an example. Say you're buying a business, that a restaurant, and I use that a lot. Like to go out a lot, so and you go ahead and you talk to the landlord. Landlord doesn't tell you anything about a potential construction coming up in the next 6 months. They're going to redo the parking lot. The buyer knew, the seller knew that yes, there's going to be some area construction going on here, which is going to affect the traffic of that business. That's something that you would have known unless somebody tells you, because it's not something that will be available in any financial documents. Something that could happen in that building or that business and that business premises that you couldn't have anticipated, nor it would be disclosed anywhere in any documents. So that is important to know. So, or if there was a threat of a lawsuit for whatever reason to that business, say somebody fell, uh, there was somebody fell on the premises, and the owner received a demand letter from a law firm, and never heard from them again, and decided not to disclose it to you. Then, once you buy the business, you end up getting served with a lawsuit. So, those are things that you couldn't have anticipated, you would have known. So, seller misrepresentation and material omissions could be an issue. Okay, incomplete financial records or unclear accounting practices. That's the reason you need an accountant or CPA helping you with the financials, because the CPA or accountant will be able to recognize if there are some irregularities as to the financial statements, some red flags, or the accounting practices that will be questionable, that raise red flags. And going back to the tax returns, you want to find out whether the tax returns are signed off by a CPA or something that the owner does him or herself. There's a big difference. When a CPA or an accounting firm signs off, means that they at the very least have verified some of the information and it's as accurate as the information provided to them, but they will not sign off on the tax return if they feel something is off. At least the CPA will not. So at the very least, having that information is important. And last but not least for this segment, disagreements about what assets are actually being included in the sale. And that has to be clear. Sometimes people want to take some equipment with them, or they want to use the same trademark for another restaurant or another business in a different city. What is being transferred, what is not being transferred is important. And another one is non-competition agreements, where when the business owner can or cannot compete or cannot do a similar business. We'll talk about that in the next segment as well. So as I mentioned to you, this is a very heavy topic. It's a lot of material here to cover. And so I'm going to stop on this one for today because I want to continue with the next segment for next week and give you a little more information that I want to cover regarding stock purchase agreements, membership transfer agreement, the difference between those two. And I'm going to cover some other topics as well. What happens if you want to bring a partner into the business as well, what to do and what not to do. So if you want to reach me, have any questions about any of the topics that I talked to in this podcast, my email is rich@richsierra.com. My phone number is 866-842-5202. If you have a legal issue, you would like to consider our legal services, my website is floridasmallbusinesslegalcenter.com. If you want to watch this podcast via video, we have a YouTube channel, and the channel is youtube.com/@RichardSierra. We're at Facebook at FSB Legal, as well as Instagram. Remember my book, Business SOS, 8 Common Legal Mistakes Business Owners Make and How to Avoid Them. It's available on Amazon, Barnes & Noble. You can ask for your local bookstores as well. Until next week, this is Rich Sierra. And remember that my goal is to help you succeed.